The year 2024 was like a roller coaster ride for the Indian stock markets with sharp ups and downs. In the first half of the year, markets were doing good. Corporate earnings held up well during this period, fueling optimism and drawing in both domestic and foreign investors. It felt like the markets could do no wrong. But in the second half, the story changed completely. In October, the Nifty had dropped by 6% in just 1 month. Corporate earnings started to disappoint, growth concerns began to take center stage. Now this of course shook investor confidence. Now adding to the pressure was the aggressive selling by foreign institutional investors. Now when FIIs pull out their money, it creates a ripple effect, and that's exactly what we saw in the later part of 2024. Unfortunately, this volatility didn't stop with the calendar change. As we stepped into January 2025, the market remains volatile. If you look at this chart, Indian markets are already down by about 2% this month, continuing the weak trend from late 2024. Now to understand this, let's start with the global picture. The United States plays a crucial role in global financial markets. Its policies and economic indicators often set the tone for investor behavior worldwide. Right now, the US markets are dealing with some challenges. Now, inflation in the US hasn't come down as much as expected. Now, this has kept investors on edge. US Treasury yields surged after strong job data. This data raised fears that the Federal Reserve might keep interest rates high for longer than expected, delaying any rate cuts. Now, why does this matter to India? Now, when US interest rates remain high, it makes American assets more attractive. This often leads to foreign investors pulling money out of emerging markets like India to invest in the US, impacting our markets directly. Now, India too has its own set of challenges. The Indian rupee has been hitting all-time lows against the dollar. Now, a weaker rupee not only raises the cost of imports, but also makes India less attractive to foreign investors, further fueling outflows. Now, foreign investors have been relentlessly selling Indian stocks. The total foreign investor outflow for January was a staggering 35,658 crore rupees. Now, this kind of selling puts significant downward pressure on the markets. Now, investor sentiment is also being weighed down by the ongoing December quarter Q3 earnings season. Now, with slowing growth and rising costs, there's uncertainty about how Indian companies have performed. Now, adding to this is the uncertainty around global trade policies, particularly those that may come from Donald Trump, which could affect international markets and trade flows. So this is why the markets have been weak this month. However, the markets have been up in the last 2 trading sessions. Let's understand why. Global markets received a much-needed boost on Thursday as US stocks rallied strongly. Now, this optimism came after data revealed a lower than expected rise in US core CPI inflation, which excludes volatile components. However, US headline inflation actually increased to 2.9% and is still above Fed's ideal target of 2%. Now, this data decreased fears of aggressive monetary tightening by the Federal Reserve, leading to a decline in the US dollar and bond yields over recent days. Adding to the optimism is the Gaza ceasefire deal between Israel and Hamas that has reduced geopolitical tensions in the region. Now, this development has been welcomed by global markets, lifting sentiment and creating a more stable environment. In another development, Hindenburg Research, known for its critical reports on various companies, has announced its disbandment. Now, earlier reports by Hindenburg on Adani's stock manipulation and accounting fraud led to significant volatility in the Adani stocks. Now, with the news of Hindenburg disbandment, shares of Adani Group witnessed a sharp recovery as investor sentiment turned positive. Now, on the Q3 corporate earnings front, several key companies have also reported positive results, contributing to the market sentiment. Now, there are rising hopes that foreign investor outflows from Indian markets might ease as the combination of easing inflation, reduced bond yields, and fading geopolitical tensions makes emerging markets like India more attractive again. Now, for Indian investors, this could signal some respite from the recent volatility. However, caution remains key as global and domestic triggers continue to shape market movements. Now, it is important for us to understand the factors that will likely influence the market's direction in the near term. Now, let's break this down step by step. Now, global developments are expected to play a significant role in driving market sentiment. A key area of focus is the US Federal Reserve's monetary policy. Earlier, there was optimism around the possibility of more rate cuts in 2025. However, with US economy continuing to show resilience, that expectation has shifted. Markets are now adjusting to the likelihood of prolonged higher interest rates. Now, why does this matter to India? Now, global monetary policy influences foreign exchange, our Indian rupee, and overall market stability. If US interest rates remain elevated, foreign investors may adopt a cautious approach towards emerging markets, including India. On the domestic front, there are 2 major events on the horizon. First is the union budget. The budget will be crucial as it outlines the government's priorities and any spending plans. Now, any new policy announcements could drive market reactions. Now, Q3 results from Indian corporates will also provide insights into how businesses are faring amidst a challenging environment. Now, slowing earnings growth and recent GDP downgrades have dampened sentiment, so watch out for these numbers for any signs of recovery. Now, together, these factors will define the domestic narrative and may influence short-term market trends. Now, we are also seeing markets on an uptrend for the last 2 days. However, the sustainability of any such rally will depend on fundamental factors, particularly a revival in GDP growth, improved corporate earnings, and also positive global factors. Well, now, without these, any upward momentum may be temporary. Having said that, this is me, Merlin, signing off. Take care and stay invested.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.